Hi, David. Thanks very much for having me, and Happy New Year, everybody. I hope you have had a great festive season. Look, what I thought I'd do is just run you through the Q2 results that we presented to the market back in November and give you a little bit of an update as best I can through the continuous disclosure regime of how things have tracked through Q3, because we have our 4C announcement due at the end of this month. So if we could just skip through the disclaimer slide, please, David, and we'll go straight to the highlights. And I guess the one I'm really keen to emphasize here is the improvement in our income, up 28% quarter on quarter, or around $3 million from Q1. And somewhere close to up $4 million on the quarter of Q2 FY22, up some 34%. So really strong income growth that we are experiencing and continuing to experience. As we mentioned, with our net transaction margin improving 260 basis points to 4%, we considered that a peak at 4%. We think our NTM will settle somewhere between 3 and 4%, and that is consistent with what we are seeing in the Q3 numbers that we're reviewing right now. I think a couple of really important numbers yet to cover off here. Obviously, our EBITDA improving by 270 basis points to a small negative 1.3%, and our gross losses improving markedly, down 130 basis points to 1.5%. I'm going to spend a little bit of time on the UK defaults in a subsequent slide, but you can see the significant improvement in the UK, our growth engine, with default rates down a big 277 basis points. Why is GMV per customer important to us at 14% improvement? It's because we have stepped away from the vanity metrics of active consumers and active merchants. We are after quality, and that is quality in the consumer book that we operate and quality in the merchants that we onboard. And I'll talk a little bit more about that shortly. Can we just go to the next slide, please, David? Our strategy on achieving profitability has been unchanged for the last 12 months, and all about 3 key pillars. Saving to invest, which is largely self-explanatory. Any savings that we are making in the company through improved operational process or procedure, and of course the tough decisions we had to make in July to downsize our team, have been invested back into the business to make our platform provide a better service for our consumers and our merchants. As I alluded on the previous slide, this is all about us increasing the quality of our customers and our merchants. What do I mean by that? Well, you will see in some subsequent slides, we have intentionally removed thousands of bad acting consumers from our platform, and similarly hundreds of merchants that we have identified as bad actors as well. That means we are trading on a GMV that is richer in terms of NTM and revenue than previously, hence the numbers you saw before. The final pillar in our strategy is all around the reduction in fraudulent activity and credit risk, credit loss. We have invested a lot of money in people and processes, and we continue to invest in systems, and you'll see the evidence of those efforts in some subsequent slides. Next one, please. So here's a few key metrics that we'll run through. If we just go to the next slide, thanks. So as I said, very strong growth in income, as you can see, up 3.2 million on Q1 and up almost 4 million on Q2 FY22. Our quarterly NTM has had a massive improvement, and as I say, peaking at 4% in our view. And importantly, that operating EBITDA, both in dollar terms and as a percentage of GMV, is showing very marked improvement. We'll go to our next slide. This is where I'd like to spend a little bit of time, because one of the key drivers of improved NTM, of course, is that improvement in default rate. And as you can see, our group defaults have fallen from a peak of 4.57% to 2.05%. More importantly, by region, you can see how we have rapidly and significantly got our default rate in the UK under control. It was worrying at that point of 6.06, as you might appreciate, but certainly at 2.39%, a massive improvement, and we are continuing to see that improving trend over the course of the last 3 months. New Zealand and Australia has never been a major issue for us in terms of defaults. A little bit of an increase there, which we are putting down to the macroeconomic situation that all consumers are feeling right now with the cost of living increases. Our orders per active customer in the UK are significantly higher than those in Australasia, and that is down to the fact that we have an affiliate program in the UK that provides access for our consumers to the top 500 UK retailers. As I've alluded, GMV per customer is up 270 basis points, which is a very big increase year on year. Go to the next slide. Just showing you where we're stabilizing our GMV. As I said, we are not about focusing on what I do term vanity metrics, which is active customers and active merchants. The simple fact is, last year when we were being encouraged by the market to grow at any cost, active customers was a key metric the market was looking at. Active customers are defined as those who have shopped in the last 12 months. We knew going into Q3 that we had attracted a lot of bad actors prior to Christmas 2021. That would drop off our database because they only shopped once, they were defaulters or fraudulent actors, and we've wiped them off our platform. So I'm not at all concerned about where we're tracking in terms of active customers, active merchants. My focus is all about quality GMV. If we go to the next slide, please. And as you can see in the United Kingdom, our UK GMV per customer continues on the trajectory that we have been looking for, and we're very happy with how we're performing in the UK. As I alluded, Q3 of FY22, prior to Christmas last year, we onboarded a massive amount of bad actors, which drove that £87 million in that quarter. We had every expectation of that being lower this year, and as a result, fewer active customers, because a large portion of that 87 million were bad actors. We go on to the next slide, please. Same goes for Australia and New Zealand. In New Zealand, in Q3 last year, Auckland, our largest city and largest catchment, was still in lockdown. So we gained the benefit of that COVID increase through October, November, and December. That obviously wasn't the same this year, but Q2 was still a solid quarter for us across both those jurisdictions. And again, our GMV per customer is continuing to track where we want it to. Next slide, please. Supporting us, we have two very good partners providing the debt support for our debtors ledger. Partners for Growth have been a fantastic support for us in the UK and continue to provide that support as we work in that UK market and look to grow further with a quality book. Similarly, Kiwi Bank here in New Zealand, long supporters of Laybuy, have been with us since 2017 and have been a terrific support for myself, the board, and the management team. So we're very blessed with the partners we have on our debt facilities, and I can't speak highly enough of them. Go to our next slide, please. Next one, thanks. So look, from an outlook perspective, nothing much has changed in terms of where we're at today than where we were back in November. We're reaffirming our commitment to achieving profitability by the end of this financial year. We had a small positive EBITDA that we achieved in September, and we have had a very solid performance over the course of Q3. More to come on that, obviously, with our 4C announcement. As I mentioned, our NTM, we expect to normalise between 3 and 4%. The Q2 performance was a peak. I don't expect NTM to be at 4% for Q3. I don't expect it to be below 3 either, but all I'm saying is 4 was a peak. Those anticipated savings of $20 million as a result of what we've been doing through our restructure have been invested back into the business, and they are supporting that pathway to profitability. What I would highlight that we alluded to back in November is that we do see the inevitable post-Christmas hangover kicking in already in January across all three markets. That is seasonal, that is anticipated. And I think when you consider the hangover from Christmas on top of the general malaise in the economies around the world, that is not unexpected at all to see the softer GMV numbers. And having said that, we don't expect that to impact our profitability adversely at all. We have continued our tight approach to credit risk when we go through our onboarding of consumers, very mindful of that macroeconomic area. And as I say, we do have an expectation that we'll be profitable and self-sustaining by the end of our 2023 financial year. So look, I'm very happy to take any questions you may have. David, I'll pass the mic back to you.
Gary, thanks, and a great presentation. And not a pivot's the wrong word, but you've clearly taken some very strong and proactive steps in reshaping the business and aligning the business to profitability, and in some respects decoupled a little bit from what the market expected of you or expects of you from a growth point of view, and looked at a sustainable model that will drive the business profitably and successfully going forward. The question just in terms of profit, so you've obviously put the number out there saying that you believe you'll be there by year end. Is that, are you comfortable that you're tracking towards that goal?
Yeah. Yes, I am. Yeah.
And when you get there, the initiatives that you've used to get yourself to profitability, do those initiatives start to lessen a little, or do they just ramp up or stay the same?
They actually ramp up, David, because we've got a couple of new things we'll be rolling out over the course of this calendar year that will actually enhance our profitability. We've also exited a couple of areas of the business that we're not delivering on any sort of ROI that we wanted. I can't articulate that at this point because we need to run that through the normal channels as an ASX listed business. But the improvements that we are seeing are definitely sustainable and in fact are improving.
And in terms of the buy now, pay later sector has clearly seen changes, and some companies have just dropped away because they haven't taken that proactive stance. How do you think the sector looks in 3, 6, 12 months from here, or even longer?
Oh, look, I think the sector is providing a service that consumers are embracing globally. And sometimes down this part of the world, we could become somewhat shielded from the fact that in the Northern Hemisphere, buy now, pay later remains in its relative infancy. So I think there's a lot of runway left there yet. You know, we at Laybuy have sustained our performance in the UK, have continued to grow in the UK. We've watched some other participants choose to exit that market. We're very proud to be recognised as one of the top 3 in the UK market, and we continue to have confidence in our ability to stay there. So I think buy now, pay later is here to stay as a payment method. I just think that inevitably everyone has to evolve, and we're doing that, and I have no doubt at all that our competitor set will be evolving also.
How do you see growth going forward? Obviously, you touched on in your presentation that it was a growth at all costs model, largely because that's what the market was expecting of you. And now you've reshaped to be focus on profit and sustainable profit going forward. Does that lessen your growth going forward, or does it just match it more to where the business is and sizes to where the business is at that point in time?
Yeah, David, we are still growing. We're just not in a hyper growth mode that costs you a lot of money. You know, I have a retail background as a CEO for 16 years. I'm not used to running companies that lose money. I never have until we started this one, and it was a growth business, and the expectation was you did. We are focused on being a profitable business, a self-sustaining business, so that our requirements for capital come from our internal resources, not external.
And is that early growth, and as you said, there was a hyper growth phase there, but was that early growth surely was very important to giving you the foundation now to build your profitable business?
Oh, yes, it was. I think, we're all very wise with the benefit of hindsight, aren't we? And, we unquestionably got turbocharged through COVID. As a result of that, we grew 500% year on year in the UK from 20 to 21, and another 100% from 21 to 22. I would have liked to have seen that with the benefit of hindsight growing at, say, 200% year on year as opposed to 600 over 2 years.
Understandable. A great outlook, clearly focused on profitability, matching the company and its operations to the profitable growth that you're looking to achieve. Gary, clearly a hidden gem to watch in 2023. Thanks for your time, and we look forward to following the story.
Thank you, David, and we'll talk to you again soon. Happy New Year.